Welcome to the All Financial Hour podcast with Steve Aul.
Every year, the government issues a cost of living adjustment. You may have seen it called a COLA for Social Security. It's supposed to help keep up with inflation. And in 2026, the COLA will be a whopping 2.8%. And on the average monthly check, the new COLA translates to an extra $56 a month. Steve, should retirees really count on pocketing any of this increase? I mean, it's not $56 isn't that big of a deal.
It's not, but it's better than nothing. And remember, that's average. There are those that are going to get more, and there's those that are going to get less. It depends on how much Social Security you're already getting. So optimizing Social Security is very, very, very important. But you also have to look at it that there's also going to be an increase in Medicare premiums. The only thing that's good about that is when the inflation was very, very low and it was down around 0% with almost no cost of living adjustment for Social Security, your Medicare premiums cannot go up by more than your increase in Social Security. So it's kind of one of those catch things that you don't go in the hole because of your Medicare cost. But it is going to increase Medicare. We're not going to find out exactly what Medicare is going to cost until later in the month. You can usually go online near the end of November, and it'll give you a better idea of what the cost of your Medicare is going to be. So we look at those two things, and we look at Medicare costs and your Social Security benefits. And that's where I think we have to look at the options for both. Optimizing Social Security is very, very, very important. A lot of people think, well, I'm going to turn 62 and I'm going to stop working and I'm going to turn on my Social Security. That was years ago. Now I'm 65. I can now turn on my Social Security. I can get Medicare. So 65 is kind of the magic number now. And I look at it to the point, optimizing your Social Security is very, very important, especially for married couples. Why? Because that survivor benefit is going to be based a lot on the higher of the two Social Securities. So that's the thing that we're going to look at. Not maximizing Social Security, optimizing it. We don't want to both wait till 70 and live a long time. That's probably the maximum that you could get. But depending on health, depending on incomes, it might make sense not to delay for the two of you all. The other thing that we have to look at is your modified adjusted gross income, because that's what affects your Medicare. So when we start to look at Roth conversions of taking money out of accounts, where do we get that money and how do we do those incomes? We need to look at those modified adjusted gross income. Why? Because if your income gets above a certain number, your Medicare is going to go up automatically if you're married, for both you and your spouse. This year, you got a little bit more playroom. Why? Because in the one big beautiful bill, if you're over 65, income's less than $150,000, you might get that extra $6,000 in standard deductions. But again, it does phase out with incomes over $150,000. So right now, we've got a few different things that we'd have to look at when we're looking at optimizing Social Security and or Roth conversions to try to shift some of that money that's going to be tax deferred into taxable. So if you haven't taken Social Security yet and you're looking at how could you optimize it, give us a call and ask about Social Security optimization. If you're looking at how do I keep my Roth conversions and do it under that modified adjusted gross income, give us a call and ask for a tax analysis so we can assist you in what might be a benefit for you by doing Roth conversion. Give us a call now. Allow myself and my team to help you.
If you'd like to come from this Social Security optimization or this tax analysis, 636-230-8824. That website, Your Money Matters, STL.com. Steve, I don't know what the deal is. I have heard more commercials and seen more commercials about gold in the past week or two, and I think this thing's got some legs. I don't know what's going on.
Well, I think the thing when you start to look at gold is exactly what you've said. I hear about it from everybody. People that don't follow anything with investing. When my wife asks me questions like, how much gold do we have in our portfolio? I know that everybody's talking about it.
Yeah.
and we start to look at gold year to date is up about 52 to 53%. So it's up quite a bit this year. It was at a high, and then it dropped about 8 or 9%. But best time to probably buy gold was about 2.5 years ago. And where my thing of his people was, should I buy gold now? I don't know. My crystal ball's completely broken. Could it be higher later on? It could be. But it's been my experience, if you look at commodities in general, commodities kind of trickle up over time, and then they drop very quickly. So that's the thing that we have to be careful of, because looking at it right now, I like to avoid those situations where you, quote, buy high, and then when it starts to drop, sell low. Mm-hmm. But I believe that gold should be a part of your portfolio. I don't think it should all be in there. And I don't know if I would buy a whole bunch at record highs. But then we have to look at it and sit here and say the rest of the market's up. What are you doing to protect those gains? I don't think just buying gold is the answer. I think looking at it and saying, maybe I should move assets around. Maybe I should sell some while it's high and buy something else that might be low. And that's where I look at it for most portfolios. The thing that I see that does not happen enough with people's investments is the rebalancing of your portfolio. It's way up, and then somebody comes in. I said, I like to sell this, and I'm going to sell the things that are high. And they go, why would you sell those, sir? Those are real high. I said, because I want to buy low and sell high. Mm-hmm. And then I'm going to shift it into some of those asset classes that are lower. Because if you look at investments over time, it's not the same class that's high every single year. Large caps might be high one year, but they're down. Internationals might be high. So I think shifting and rebalancing your portfolio is very, very important to do. And that's where I'm looking at. If you're not sure, you've got some nice gains in your portfolio, but you're really not sure exactly what to do in it, come in, let us run a risk-reward analysis. Let us find out, should you rebalance? Are you okay? If you're a 50-50 investor and you now have 75% of your money in equities, you might be taking more risk than you're really comfortable with. And when markets get too high, what happens a lot of times, they start to fall. So you're taking more risk than you really need to do. Give us a call now. Ask for that risk-reward analysis. Let us look at where you're at and see, is that in line with your goals and what we could possibly do to assist you with that.
And again, that phone number is 636-230-8824. It's a great conversation to have. You'll sit down with Steve one-on-one. Again, that's 636-230-8824. That website, yourmoneymattersstl.com. Personal finance expert Susie Orman, she hosts a podcast called Women and Money. And a woman wrote in and said that she was torn about her pension decision. Said she could either take the $450,000 lump sum or a $3,000 monthly check. Susie answered that if you take the $3,000 a month for life, you're going to run the risk of the pension program being changed or even ending. And there's no legacy when you die if you go that route. So her advice was take the $450,000 lump sum, split it, put some in an annuity, do the other and invest it. Together with your Social Security, Susie estimates that she's going to be fine. Steve, I want to get your take. Is this the route you would have taken?
I have to look at it and go, it's hard for me to say, is this the right without gathering all the information. With this in your Social Security, put part of it into an annuity, you could be fine. What's fine mean? I got a lot more questions. I'm assuming in this case that the lady was single, but what if she wasn't? Then I got to say, is it married? Their living expenses, the overall living expenses. Again, what does fine mean? You're within a range. How many other assets do you have? What other incomes could possibly be involved with this? I like to look at people's risk reward. A more conservative investor, I might lean a little bit more towards the pension. Why? Because that's a set income and they're not willing to take the risk for higher gains. What's your overall health? Are you doing well or are you not doing well? And longevity. How long were mom and dad around? It's not an exact for when things are going to happen to you, but I think all of those things need to come into play. I do agree with Susie's idea of, I think controlling some of the asset can be very, very important as long as I don't need it all to meet my lifestyle. So we have to look at all of these things when we're doing a plan for people. It's not as simple as just take the lump sum, just take the pension. We have to look at the whole picture and see how that piece fits within the puzzle. Because income is only one part of the puzzle. Taxes is another part. What are you doing about that? Long-term care. Do we need that or are we going to self-insure? Fees. What are the fees going to cost me? Your allocation for your portfolio. All of those things have to be looked at when we're putting a plan together. It's not as simple as, do I take the lump sum or do I take the pension? We have to look at the whole picture to make sure that that answer fits for you, because that answer is different for everybody. And you have that availability. If you don't have the pension, what about doing a personally funded pension? Taking some of your money and set it aside, just like she said. Put it into that annuity for the guaranteed income so that you can help alleviate that fear of running out of money in retirement. Because in its simplest form, pensions are annuities. So that could be important for you. If you're not sure exactly what you want, give us a call. Ask about the personally funded pension or a comprehensive retirement plan so we can see how that might fit for you.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.